entertain the possibility that returning to the 2% target will not be possible with the current level of the Fed funds rate?
So I think, as I just mentioned, I do think it's really a question of keeping policy at the current rate for a longer time than had been thought. I think by many measures, the policy rate is restrictive. The question is it sufficiently restrictive? And I think that's going to be a question that time will have to tell. Entertain the possibility is, that could be a very small probability, but I have said that I don't think that it's likely, based on the data that we have, that the next move that we make would be a rate hike. I think it's more likely that we'll be at a place where we hold the policy rate where it is.
And is there any particular component of inflation that concerns you? A lot of people in the US have been focusing on housing and that segment, but is there that, or is it something else that?
So we think of it in three buckets, the first of which is just goods inflation. And goods inflation was negative for 25 years, mildly negative because, of course, globalization and many goods were manufactured elsewhere and shipped at lower costs. So that, I think, is performing broadly as expected over time. We had very high goods inflation at the beginning of the pandemic because of the supply chain issues. That came down a lot, and I think we expect that. Housing inflation has been a bit of a puzzle because current rents have been low. Current rent increases have been low for some time, but they're not showing up. That's not showing up in rollover leases and in owner's equivalent rent. So, I think what we've learned is that the lags between a decline in market rents and it showing up in the measured inflation for housing services is long. Their lags are longer than we thought. But as long as market rents don't go, as long as they're going up at very modest levels, it will show up. It's just a question of when. I think our estimate of the lags is there, and so you've got to look at that. That may affect your confidence, but we have to wait for it to happen. In terms of the biggest part of it is services inflation, non-housing services, and that's more than half of the index. And it's less interest sensitive. It's very sensitive to wages and that kind of thing. We had made some progress there, particularly if you look at the market-based aspects of it. But that's the one that I think may take the longest. At the same time, it doesn't need to go to 2%. It wasn't at 2% before the pandemic. You need the three of those to come out in some way that they're at 2%, and I'm confident that we will get there.
Reasonably high PPI reading today from the US, Chair Powell. Some people have said that looks hot. What do you think of today's reading? And more broadly, is there a risk that inflation becomes a lot more of a problem in the US than it is elsewhere?
So we had a producer price index reading just a couple of hours ago, and I would say it's actually quite mixed. The headline numbers were higher, but there were backward revisions, and we're of course disassembling it, taking it apart, and looking at it. I think markets and analysts are looking at it as I wouldn't call it hot. I would call it sort of mixed. But in terms of the overall picture for inflation, I think you have to go back to last year, where we had historically fast disinflation. Inflation came down by two full percentage points last year. Why did that happen? It's really two forces working together. One of them is just the reversal, the unwinding of the pandemic-related supply and demand shocks. So that we thought we would always get that. We thought we'd get it in 2022, and we didn't, and then it really arrived in 2021. So that was a big part of this, was just the reversal of distortions, really, to both supply and demand. The second thing is just restrictive monetary policy, and restrictive monetary policy cools the economy and makes room for the supply side to heal, but also lowers demand and ultimately lowers inflation. So I do think those two have been working together. And the question you ask is inflation going to be more persistent going forward? I think, and that would essentially mean that we've gotten the supply side gains that we're going to get, and now it's down to lower demand, which would take longer and potentially be more painful. I don't think we know that yet. I think we need more than a quarter's worth of data to really make a judgment on that. We know that there are still businesses still report that there are shortages and labor shortages and things like that, which are now being addressed. In addition, even when the shortage is alleviated, there should be lags before that shows up in economic activity and inflation. So there may be some more there. I don't want to give up on it yet at this point. I also think that having restrictive policy, we have the highest interest rates in some time. I think that it may be that takes longer than expected to do its work and bring inflation down. I am confident that we will do that, but that we will get inflation down to 2%, and ultimately we will do what we need to do with our policy rate. The U.S. economy has been performing very well lately. We had growth last year of just over 3%, quite a strong year. And it's driven by a number of things. I would point to a very strong labor market where you've got rising employment, you've got rising wages, so disposable income. Consumers are spending. Generally, households are in good shape financially. They're not over-levered. And so we see a good picture. Consumer spending has held up very well. As well, business investment has been strong. Businesses are seeing opportunities to invest, and that has helped. I would also point to a fairly large influx of immigration into the country over the past couple of years, and those people are joining the labor force. We're experiencing still a labor shortage in many industries, and so there are jobs, and they're going to work and they're consuming. So that's also boosting growth. So overall, a good picture looking at the data so far. The labor market is very, very strong. It was, I think, overheated a couple of years back, and what we've seen is it coming back in gradually into a better balance over the last couple of years. And now I think if you look at a broad range of data, you could say that the labor market is about as tight as it was before the pandemic in 2019, and that's good. Real wages are now positive. And unemployment has been below 4% for 27 consecutive months, something that hasn't happened in a half century. So, labor market very strong, and again, signs of gradual cooling and rebalancing, so that supply and demand of workers is coming back into balance, which just as we would want. Inflation. It's worth starting with the fact that on a 12-month basis, headline inflation.
Welcome to the Crypto Teacher. And I come back with that video just to make you think.
Don't forget to like and subscribe to the channel.
And make sure you join the Patrons. If you're not a part of the Patrons, make sure you're hitting the Cash App. And we have Jerome Powell in the house, guys. And he was honest about one thing. Higher for longer. And interest rates should have skyrocketed today. But they didn't. They were only slightly higher. And we had another number come in, still high, PPI. And these numbers are going to stay inflated, guys. We only have a few corporations that own everything. They control the pricing. And Jerome Powell stated he doesn't look to raise rates, but he's definitely not cutting. But guys, we know he's going to be cutting rates at the end of the year because we know we're going to hear those drums are beating. And this is an election year. Going towards the back half of the year is going to be probably one of the most entertaining years we've ever had. And then remember, starting in 2025, they're going to start pulling down this curtain and wake the sheep. But we know by the time they wake up, these machines would have taken over the economy. But Jerome Powell started off and said the U.S. economy is doing great. And then he talked about last year's numbers. Guys, you can't make this stuff up. That's the reason why they don't teach finances in school. He didn't talk about nothing this year. He talked about last year. Yes, the economy grew 3% last year, but this year, only 1%. And never forget, they printed 80% of all money in existence in about 2 years. Anybody with common sense that's paying attention know we were going to get inflation. And they raised rates so fast, they didn't allow the rates to get into the economy. And now it's happening. Everything's crumbling. And even when they do start raising rates, the damage is done. And they know this. But remember, guys, we're in a fragmented world. They have to break up this whole global economy in order for the fourth industrial revolution to rise. Whether robots, algorithms, and drones take the economy over, pay each other with crypto, and the sheep go inside the metaverse. And because the rates are so high, next year a lot of these companies have to refinance. And guess what? They're going to be refinancing at a higher rate that they're not going to be able to afford. And we already see bankruptcy after bankruptcy. You wait till next year. You see the amount of layoffs that's going to happen due to these high rates. But again, guys, this is part of the plan. And remember, it moves in phases. And that's the reason why the drums are going to get louder going towards the end of the year, because they need that crisis. Remember, in a crisis, you can do things you never thought you would be able to do. And remember, the crypto teacher told you, because he knows when it comes to the NWO, it's all planned out. You have a wonderful day.
Got as high as 7.1%, is now down to 2.7%. Core inflation got as high as 5.6% and is now at 2.8%, so it's down by half. That progress, though, really happened over the course of last year, particularly the second half of last year. The first quarter in the United States was notable for its lack of further progress on inflation. We had higher readings in the first quarter, and higher than we expected. We did not expect this to be a smooth road, but these were higher than I think anybody expected. And so what that has told us is that we'll need to be patient and let restrictive policy do its work. If I turn to the outlook just for a second, I would say we expect continued growth, 2% or better. We expect the labor market to continue to be strong, but to move further and further into balance. And I expect that inflation will move back down on a monthly level, on a monthly basis, to levels that were more like the lower readings we were having last year. I would say my confidence in that is not as high as it was, having seen these readings in the first 3 months of the year. So we're just going to have to see where the inflation data fall out. And I'll stop there with the economy. Thanks. I agree with all of the factors Klaus laid out. I would add we're probably also benefiting from a sort of a strictly accounting GDP standard from new workers coming in to a large extent. I think the issue really is, and this is an issue that that the European economic policymakers are very, very focused on right now, is over the longer run, Europe's productivity growth has been about half of the U.S. And that's so ultimately all you've got is hours worked, and that's largely a function of population, hours worked, and then output per hour. That's going to be your economic activity and growth. And so productivity is, really the thing that can enable living standards to rise over time. And there are a lot of theories on why that might be. I think from an American perspective, I would tend to point to the more flexible labor market, and also a more fully built out set of capital markets, which is parts of which are very focused on funding early stage innovative companies. So it's not just a bank-centric system. We've got a very highly evolved, financial system. Look at the bigger picture. We've seen the labor market's a good place to see this. You've seen demand for workers cooling off pretty substantially. The ratio of vacancies to unemployed people, for example, has gone from more than 2 to 1 to now 1.3 to 1, and it was 1.2 before. So that's a decline in demand. That's demand related. You also see wages coming down. You see quits coming down. So I think that tells you that policy is probably restrictive. I think it's also fair to say, though, that the U.S. economy is different this time for a couple reasons. One is that people financed themselves into very low rate mortgages, and now they won't move because they would be moving into a higher rate mortgage if they did, and they would be throwing a lot of value away. The same is true of businesses, many of which, as indeed you would expect, have termed out their debt. And so they're not feeling the effects of interest rates. So it may be that policy is hitting the economy not quite as strongly as it would have if those two things were not the case. Notwithstanding that, I think the overall picture still is policy's working. It's weighing on spending. It's weighing on interest-sensitive spending, and it's certainly weighing on the labor market. It's a question of restrictive policy. As I mentioned, our policy is the highest it's been in quite some time. The rate is, at 5.25% to 5.5% is high relative to recent history. So we think that it's probably a matter of just staying at that stance for longer. And, that's how we're thinking about it. But these are different. They don't have, and runs are responsible. Bank runs or things like that are really responsible for an awful lot of the problems that happen in one form or another. So the non-bank financial sector doesn't have that as much. Another thing is the ties between banks and the non-bank financial institutions are substantial and growing. So there's plenty of monitoring for us to do there. It's not obvious to me that at this point that it's a net loss to financial stability, but I would say our jobs are to monitor it very carefully and thoughtfully and understand the implications. Going to a different economy, and we're going to be learning more about that as we go, but clearly we're learning that things can be done from remote locations. We're learning that technology can replace people even more than we thought.
We're not going back to the same economy. We're recovering, but to a different economy, and it'll be one that is more leveraged to technology. And I worry that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance agents, lawyers, and on through the economy. So what happened to the manufacturing workers is a very clear sign.
And so we'll import Chinese-based CBDC technology. So it's going to be CBDC in a box provided to you by the People's Bank of China.
But every stock, every bond, every currency, every commodity, every piece of art, every private business, every piece of real estate will eventually be a token on a blockchain, an entry on a ledger, permanent and immutable. We will have truth instead of trust, and we will save over $7 trillion a year. 6 to 8% of global GDP is wasted by the friction of the trust industry that's necessary when you have dual entry accounting. With triple entry accounting, which is what a blockchain is, we get rid of all of that friction. It's a beautiful future.
Like what you see in China and their social credit scoring systems, right? If we get identity wrong, it could be a tool to enslave humanity. And if we get it right, it could be a tool to liberate humanity. And as an American, I'm obviously rooting for the one that's on the side of freedom.
Bitcoin is an international asset. And also, I do believe the role of crypto is, it's digitizing gold.
I actually believe this technology is going to be very important. Look at it. We have been part of the huge revolution in investing through ETFs. We believe that ETFs will be changing the whole way we invest. Many people still use it as a means, people are investing it for indexing. No, the majority of people who are putting money in in ETFs are active investors that are buying exposure. The entire bond market is being transformed as we talk right now. I believe the next generation for markets, the next generation for securities will be tokenization of securities. And if we can have that distributed ledger that we know every beneficial owner, every beneficial seller, we all have our code of who's buying, who's selling, instantaneous settlement. And think about it, it changes the whole ecosystem.
Chinese bank ICBC has been hit by a ransomware attack, and the U.S. Treasury market, as a result of that, has been disrupted. This, according to the Financial Times. We're getting more right now with Bloomberg's Sonali Basak. Sonali, what do we know?
Listen, we have the Financial Times now reporting that ICBC, one of China's largest banks here, was hit with a ransomware attack. And remember, they're a very significant intermediary in the Treasury market. The SIFMA has told its members that this has been part of the reason here that the system is kind of clogged up, if you will, during that auction that we saw a little bit before. The attack had prevented ICBC, according to the Financial Times, from settling Treasury trades on behalf of other market participants. A large executive at a major bank also telling the paper that such a large party on the fixed income clearing corp creates major concerns, potentially impacting the liquidity of Treasury markets.
Now, it was not just a poor auction. It was absolutely lousy, and When the dealers have to step in to save a treasury auction, that's a rare occurrence. I hate when countries go off the dollar. I would not allow countries to go off the dollar, because when we lose that standard, that will be like losing a revolutionary war. That will be a hit to our country, just like losing a war. And we can't let that happen. And too many countries now are fighting to get off the dollar.
Cryptoteacher and the New World Order book, plus the 3 Kids books. It's time to re-educate. Also, new to cryptos, Coinbase, Bitrue, Binance. Do not forget book links and crypto links are in the description. The stock channel, guys. Don't forget to go like, subscribe, spread everywhere. You have your Kobo, your chip stocks, your banking, your gaming. While everybody's sitting at home, get home stocks, the Seaver, the biotech stocks. And while everybody's at home wishing they were still getting that free money, what are they doing? Drinking and smoking weed. Don't forget about those stocks, and you have a wonderful day. The most powerful person in the world is the storyteller. The storyteller sets the vision, values, and agenda of an entire generation to come. Steve Jobs. And guys, you know I truly believe in this. When you look at the New World Order, they're the storytellers. And that's the reason why I wrote my New World Order book. But guys, now it's time to change the current generation. And I wrote 3 kids books. You know, I love the Trinity because I understand the power that's in it. So I have 3 books. We have an opportunity to change the generation, to educate, not just me, but I want to show you that I take action on a daily basis. And I want you to take action on a daily basis. Whether it's your job, whether it's in your community, we have an opportunity right now to educate the masses. I posted this on my Twitter account. Please share, but this is a short clip of the 3 books. There's going to be a clothing line and action figures. Please get these books for your kids, nephews, cousins, friends, so therefore we can start the re-education now. Because as we see, the 4th Industrial Revolution foundation is definitely here. Robots, algorithms, drones, taking humanity out the picture. We have to re-educate. But let's get into the video.
Part 1. King Joshua and Grandma Tam save the village. Part 2. King Joshua and Grandma Tam save New York from COVID-33. Part 3. King Joshua and Grandma Tam goes to China.
It's mandatory to get part 1, part 2, and part 3 of this series. It's time to re-educate Generation Z.